subscribers, to the Saturday Summary for April 5th, 2014, your weekly summary of market and economic news for annuity and life professionals. I'm Jonathan Illig of Brokers Alliance and Outlook Advisors, here for the biz. Now, after starting the week of gains driven by Fed Chief Janet Yellen's Sunday comments to the effect that the Fed would continue extraordinary measures to spur the economy, meaning, of course, the markets, the week ended with a brutal Friday, with the S&P 500 declining by 1.25 points, the Dow Jones Industrial Average losing close to a point, the NASDAQ index dropping over 2.5%, and the Russell 2000 index declining on Friday of over 2.3%. Now, despite this, with the exception of the NASDAQ Composite Index, the other broad U.S. indexes actually finished the week with slight gains. Nevertheless, as we see at the table on the written summary and the graphics here, the broad indexes remain essentially flat thus far for 2014. And as I mentioned in last week's summary, thus far this is a risky train ride to nowhere. Now, the talk of all the whole markets and the financial world this week was high-frequency trading. This follows the publication of Michael Lewis's book, Flash Boys, last week, which exposed to the mainstream press what those of us who follow this stuff regularly have been concerned about for several years. Now, for those not familiar with the issue, bear in mind that at least 70% or more of the trades in the markets are made by very high-speed computers based upon algorithms reacting to prices, news, things like that. But computer trading in itself is not what this HFT debate is all about. Rather, it is the element of high-frequency trading that many believe is illegal front-running in order to extract short-term gains at another trader's expense. Now, specifically, if trader A has no genuine intention of purchasing a stock but learns through non-public information that buyer B is about to purchase a large volume of that stock, and trader A goes out and he buys that stock first so he can very quickly sell it to buyer B at a slightly higher price. This is a practice known as front running, and it's illegal under SEC rules. Well, this is exactly what happens with a large element of high-frequency trading, and it generates billions of yearly profits. The difference is that the supercomputers are doing it instead of individuals. Now, the high-frequency traders use supercomputers to intercept buy orders before they reach other exchange computers. They buy the stock, then they resell it at a slightly higher price to the entity that has placed that stock purchase order. This happens in literally hundredths of a second. So to paraphrase TV host Jon Stewart, so if the person does it, it's illegal, but if a computer does it, it's not. Well, again, that seems to be the case. Now, I believe that this focus upon HFT front-running, if you will, well, certainly bad for investors, is the wrong focus upon the potential problems with computerized trading. Now, for most of our average near to retired or certainly already retired clients, this whole front-running debate regarding HFT is kind of tantamount to inside baseball amongst Wall Street types. And the negative impact upon them is pretty hard to quantify. Now, in my opinion, the other aspect of computerized stock trading, that is the instant buying and selling based upon computer interpretations of everything from Twitter feeds to news headlines in addition to actual stock prices and financial news, just adds to this current witch's brew of conditions that exist in the current financial markets. Now, over the past few weeks, we've covered in the summary the element of this witch's brew. What's the first ingredient? Well, ingredient one is record margin debt. You recall that on the February 15th edition, we detailed the record amount of New York Stock Exchange margin account debt, that is money borrowed from broker-dealers to buy more stocks. And our subscribers will recall from that issue the quote, "Thus, in an environment where stocks are falling, the fall of the market is accelerated by the need for margin investors to sell even more stocks to meet their margin calls. So therefore, the depth of the total sell-off gets even worse." Ingredient two of our witch's brew, the record size of the global derivative markets. Last week, March 29th edition detailed that the size of this derivative market, again, that's the bets made between large institutions on the value of assets that they don't necessarily own, is now about 800% larger than the GDP of the world. Subscribers recall us saying that when conditions upon which these bets are placed go negative, such as interest rates rising very rapidly, all these banks want to collect on their bets, but they're also losing bets at the same time. So simply put, all these players are bankrupt simultaneously and can't pay each other, causing a domino effect across the entire global spectrum. In a rush to raise capital, they sell assets such as stocks, bonds, etc., and the value of the average person's stock holdings crashes along with those of the banks. And again, you remember us mentioning this is exactly what happened in 2007. Finally, ingredient three to the witch's brew, the hair trigger for selling due to computerized trading. Now, with 70% of all the market activity based upon hundreds of computers programmed to buy or sell large blocks of stock within seconds, the markets are essentially operating on a hair trigger. Now, season this brew with bubble valuations in the markets and anemic U.S. and global economic conditions, and you have a recipe for disaster for, again, near-term retirees and those already retired. So again, I say as I always do, take your gains to safety while you can. Now, that's all I have time for to get into detail today, but be sure and check out the written summary for a lot of great articles. Lots of really good articles, but of particularly importance, be sure and read the one at the back called IRA Rollover Ruling Stuns Advisors and Savings. This is extremely important information for advisors because it turns on its head IRA rollover rules we've been operating under for 20 years. Now, finally, if you want to see something covered in the summary or have comments, contact me at the email address scrolling along the bottom of your video player. If you want a better quality of true support in your life and annuity practice, again, more than just products, contact us at Brokers Alliance. Well, that's your Saturday summary for April 5th of 2014. As always, thank you for joining us, and we'll see you next Saturday.